Alright, so let's take a look at Forex Deal Butler. And I'll just throw on an hourly chart with a few days. Sorry, that was me banging around the microphone, sorry about that. I was looking to see if we had a mute button. You see, now I realize why in radio, TV, there's always a producer. Oh my goodness. Yes, I am a little loud, Angie. I realize that. Okay. Sorry. Couldn't resist. Here we go. Oh yeah, that was real hot. All right, how's that? Is that better? Okay. I don't know how that got so high. Anyway, whatever. All right, so what I was prattling on about, I was talking about various noises in the background because I'm getting ready to upgrade to Windows 7. Fortunately, with the Mac, I can install Windows 7 much easier than on a regular computer. And so I'll test it out. I won't subject everyone to my testing. That's what I was, anyway, I was just trying to explain what all the banging was in the background. So if you're watching the video, I guess you're going to get it twice. Okay, so fortunately, before I got too far down the road, looks like we're still a little hot. How about, Angie, I'll adjust this down. Let me know if it gets too quiet. Fortunately, I did not get too far down the road in talking about the first question, which is, can you give a breakdown of how you would qualify a trade using the Deal Butler? Now, I did a new series of recordings on the Forex Deal Butler's parts. Angie, are those up on the website? Did I remember to put those up there or upload them? Gosh, it's got to be. It's right about the time James was going his own way that I redid those. So this was August or September, and I did a series of, I think I did them in the one-on-one sessions. So what I did was a breakdown on Forex Deal Butler. Not sure. Uh-oh. Okay, so we'll get to that. So Angie, if after we're done with the session today, let's try and locate those. So I will, rather than try and duplicate those, since they're already done, I'll give a little bit, excuse me, I'll give a little bit of the background, and then you can, if you're confused, we can fill in some of the blanks. So I'll give a real quick overview of what we're looking at here. Okay. Now these lines represent sweet spots. Okay. So you have the sweet spot here. And of course, it would be outside of the sweet spot here. Let me actually do that in red for no, don't trade. And then, you know, back into the sweet spot here. And now because the sweet spot lines get drawn so often, if you're using Forex Deal Butler and you've got, you know, a lot of data here, which we do not. We're only looking at about a week and a half. But if you've got a month or two, it's almost unusable. So you've got to really zoom in. But I'll take those off just to take them off. Next we have the TP dots. These are the blue, orange, and red dots. These are the typical price dots. This is a piece of well, this is a concept that I learned, gosh, a surprisingly long time ago, from a very solitary and exceedingly rich trader from Canada. In fact, his system requires some non-disclosures, and so you're not getting his exact system, but it's an improvement on it. And so basically what we're doing here, and I'll just zoom in right on a chunk in the middle. What we're looking to do with the TP dots, and they're a little tougher to see now that I've zoomed in, but you can see the blue ones here and the red ones here. What we're trying to do with the dots is twofold. One, we want to measure momentum, but then we also want to have an idea of where the market should move. Okay, and there's a really interesting thing about the market, which is whenever you have a day, and I'll promise to be short. Yeah, right. Whenever you have a day that's big like this, we want to make sure that we don't assume that we're going to repeat the momentum the next day. So what we do is we take some measurements. So we look back. I'll use the bars over here actually. And so, like for example, with this big bar here, the dots, or blue, orange, and red, are actually being calculated by comparing what's happened in the past to what's happening right now. Because the idea here is that when we get this, meaning a big boost in the range of a bar or volatility, it's only meaningful when we compare it to the past. Okay? So that was my short version. And then I'll take those off. Next we have the red lines here and the blue lines here. These are 3-bar reversal lines. These can be used for entries and exits. There's a ton of stuff on the website about those. Next we have the FXT map. This is another measure of momentum, but we're looking on different time frames. Right now we're looking at an hourly bar, and so the FXT map is going to look at 4 hour, it's going to look at 30 minutes, it's going to look at 15 minute. And so what we're looking for here is if we're looking to buy, we want to confirm that with FXT green bars. If we're looking to sell, we want to confirm that with FXT red bars. And then the blue is just kind of neutral, which you will regularly see happening once the market goes into the non-sweet spot time. Now the FXT map, you have to remember, is confirmation only. Okay, it's either red, green, or not. But we're not looking for it to trigger an entry. We're just using it as a conservative filter, if you will. Then we dump down into the matrix. We've got relative strength numbers over here, which are only the currencies that we're only looking at the pair in question. In other words, we're only looking at the pound, we're only looking at the dollar. And then you can see here very quickly what those values are. The pair index, this is something that I consider taking off. Basically what you're looking at is a negative or positive number based on, again, the trend of the market. So has the pound been going up lately, or has it been going down lately? It's simply a tool to confirm. Of course, we have the pip range. What's been the range high to low from the open, and then we have all of this all this junk right here. We call it the Christmas tree. The Christmas tree is best used, again, as a confirming indicator. So in other words, had we been in a long trade, we want to look at a couple of things. Number one, what does the energy look like? You can see on the 5 minutes getting to be mixed, you've got only 2 buys, 1 neutral buy, and then a couple of flats, so that's very mixed. 15-minute is mixed as well, a buy, a sell, I'm sorry, that was a sell, geez. Kind of a neutral buy here, flat buy, because it's just mixed all over the place. Longer time frames are starting to get mixed as well. Again, a confirming indicator. Now let's talk about a trade setup or qualifying a trade. The number one challenge with all of this stuff on the screen is that there's all this stuff on the screen. The best way to look at this is, quite frankly, like this. You start with price. Price is what is the most important. All of the indicators in the world are only giving us a variation of price, what mathematicians would call a derivative of price. Let me give you an example. Everybody in the world at this point who's on the internet has heard of Facebook. Facebook is not what I would call real communication. Real communication is face-to-face, belly-to-belly communication, where you can see somebody's facial expression, you can hear their tone of voice. Okay, so Facebook is a derivative of real communication. And we could get into all sorts of studies about that, but we won't. Just an interesting hobby of mine. Let's just say Facebook tends to be more performance than reality. So we want to look at reality, right? Hopefully we can agree on that. We want to know what's really going on. So the first step in qualifying a trade using the deal butler is this. You need to understand what each individual part does. Of course, that assumes, number one, that we have a plan. Let me say that a different way. The government recognizes 2 types of traders, the commercial trader and the non-commercial trader. So if the government is willing to talk about these 2 groups, we had better sit up and listen, since the government is really best at recognizing the obscenely obvious. The commercial group as a whole typically and usually plan out their trades. Some of them have to do it because of the business that they're in. Say, for example, a farmer. Let's say a farmer is selling wheat. So we've got Mr. Farmer over here, and he's got wheat. Oh man, look at this art. I had to change careers. And he's selling wheat in the UK. So there's some cereal maker, whatever, over in the United Kingdom that needs wheat. Well, the guy over in the UK is not going to take dollars, he wants pounds. So the farmer will have to plan out a currency transaction based on what? Based on the crop cycle. Right? He only needs to worry about the transaction when he's ready to ship, and he's only ready to ship once the wheat is actually in the ground, starting to come up, etc. Okay? Now, the other not so obvious type of commercial trader is what I call the strategic investor. This is someone who has learned from working at a professional firm that they had better plan out their trades. It's really that simple. And so they have a plan every day for what they are looking to do. And then we have the other group, which is the non-commercial trader. These are what I call the opportunity investor. In other words, it's someone who is looking for an opportunity right when they sit down at their computer. And it's easy to look for a tool like the Deal Butler, and I'll also put one of the indicators on. Oh geez, whatever. We'll do dynamic RS. No, we won't. There's not enough there. Oh, for crying out loud, Mac, just put something on there. All right, so the opportunity investor looks to put a tool onto their screen like this so that they can sit down and make money, which is a form of a plan. It's just not a very good one, because typically the opportunity investor is in the category of the 95% losers. Now, it's not to say that they don't make money sometimes, but overall, that group loses money. And it is because they sit down without a plan. So the first step in breaking down how I would qualify a trade would be to first decide what my plan of attack is going to be. And as a comment, from my experience, which of course isn't infinite, and I'm just sharing with you, what I've learned over 15 years and from working at professional firms, is that it's easy to fall into the desire to put something on the chart and that the tool itself will provide the trade. And I can tell you that even at the hedge funds, there are plenty of traders who do that. But we do it while having a plan because our managers force us to have a plan. So even though we may sit down and say, all right, I'm looking at the 3-bar reversal, okay, just as an example. That 3-bar reversal will be in the context as the plan. Okay. And as you know, with the insider code, we look at several different time frames, all the way from the daily down to the hourly. So what I'm first going to do is look at the daily. I want to see what the trend, what's the trend, short-term trend, medium-term trend, long-term trend, which means, from the last 3 months, then 4 to maybe 6 months, so another, couple of months there, and then long-term would be 6 months plus. Okay, so this would be the short-term trend. This would be the midterm trend. And then, of course, this would be the long-term trend. And then when I go kind of the middle time frame here is the 4-hour. The 4-hour, I'm still looking for trends. And in fact, I'll look at them in a similar way. This would be, maybe the last month. This would be 2 to 3 months. And then this one would be 4 to 6. Now, there's no magic in any of these numbers, okay? So it's simply a way for me to get some context. I need to see what the market has been doing, and more importantly, where are the buyers and sellers coming into the marketplace. There's also a series of special reports I did on framing the market, and the framing the market deals with these numbers. And you only need a general guideline here, right? So if you want it to be 2 months, it can be 2 months. These numbers are a good guide though. But remember, there's no magic in them in the sense that you will find more trades by using them. Okay, so let me say that maybe in a better way. What we like to do as traders is to say, all right, I'm going to do 3 months because that will make me more money. And the usual question I get is, hey Mac, what's the best time frame for a short-term trend? Is it 3 months? Is it 2? Is it 1? Well, what the person is really asking me is, hey Mac, where can I make the most money? Life, the markets, business doesn't work that way. Simply guidelines. And what we do though is we assign a lot of importance to these numbers because we think they're important. And so if you trust me when I say they're not all that important because they're just a guideline. So once I have my frame of reference, and these might be all over the place, they might be mixed, so the short-term trend might be up, the midterm trend might be flat, the 6-month trend might be down. Okay, that's very common. We also have some checklists on the site which will help you to record this information. Once I've recorded the information from the daily, okay, so that would be daily information. The reason why we use the 4-hour is for this common situation where it's just all over the place. So the daily, you've got the last 3 months are up, 4 to 6 months is sideways, and then the longer term 6 months plus is down. That's very common. Then we go to the 4-hour so that we can get a different picture. Usually what you'll find is something like this where you have more of an agreement. Okay, so the longer term trends here and here will tend to agree, but then this is where we can get a little bit of clarity. We say, okay, now what I see is that, really for the last, 3 months or so, the market has been up. I realize there's some weird overlap here, but again, the time frames are not, they're not the magic fairy dust. So the 4-hour is where we get the clarification, where we say, okay, the momentum has been to the upside. And then we record that, okay? And once we've recorded all of this stuff, while we're looking at the 4-hour, this is where we can start to get a picture of the support and resistance levels. Okay, so I've pulled in a 4-hour chart here. And so we can see, here's the really short term has been up, but here's the kind of medium term is sideways. And then again, depending on how far back you go, we've also got a sideways market here, roughly, if we go all the way back here. But from April, you can see the trend is up. And if we go back even further, we'll see that, of course, the longer term trend is actually down. We start going out to over a year or more. And that's why I'm saying the time frames aren't all that important because they're going to be so mixed up. So since, let me get the pointer here so I get the dates right. So here's April 2010. We have an uptrend. What we're looking to figure out now are the places where the market might run into sellers. Well, how do we find that? Well, we find that by looking at the logical points. And you see there are 3 of them. If the market were down here, of course, we would use some different ones. But so we see 1, 2, 3. We've got 3 places where sellers came into the market. How do we know that? Well, we know that because in each of these cases, the price went down. It is that simple. And so why is this important? Well, again, you've got to you've got to realize, what group are you falling into? Are you falling into the opportunity investor who is only after the ability to sit down at the computer and make some money in the markets, which, remember, that's typically the 95% who lose money overall, or the strategic investor who is generally among the 5% that consistently make money overall? Now, of course, choice seems pretty obvious, right? Well, then what you have to realize is these moves down are not caused by an opportunity-minded investor. These moves are caused by strategic investors. They're either acting on inside information directly from the government, directly from banks, or they are closely connected with people who are. So when they sell with confidence because they know the other players in the market, they know that those other players are selling, and they're backed up with information which virtually guarantees their success. In fact, the only thing that does get in the way of their success is when they get lied to, which, yes, happens. So we focus on these logical points. 1, 2, 3. And we put these 3 points together with what's been happening short term, medium term, and long term. So let me give some more background information here. Hopefully you can see the question was on the surface very simple, right? Matt, can you give us a breakdown of how you would qualify a trade using Deal Butler? Well, hopefully you're getting to see how what I'm going through is essentially what, although in a much shorter way, what I'm talking about in the insider code. And I say essentially because we've made some refinements, of course. But again, you've got to realize that the insider code course and what I talk about comes from a strategic investor standpoint, or a strategic trader standpoint, not from an opportunity investor standpoint where, hey Max, just give me a tool where I can sit down and take a trade. You can do that once you understand this stuff. And so as a little bit of the background, that's how you get into the category, the 5% who consistently win. So I'm trying to repeatedly give you the reason why we're even going through this information again. Okay, so we have these logical points. We look forward then from these logical points in order to develop a strategy. So we know short-term price has been moving up. And of course, price has to move up short-term for it to eventually move up long-term, right? I mean, one kind of flows from the other. It's logical. We have to have price moving up on the 4-hour chart in order to have price moving up on the daily chart. And so this is expected, or let me say this a different way. I really didn't mean to say this was expected. All right, so let me just start over. Price is moving up on the short term to the upside. We have to acknowledge, though, this medium term sideways price formation, right? Hopefully you can see now that I've drawn a box around price that the pound really, what is this, back in July of 2010, hasn't gone much of anywhere. Now the range has been big. Right, it's gone from 6,000 down to 5,300, back up to 6,300, back down to 5,300. So these moves are huge here. But there hasn't been a new high since the market made this high, and there has not been a new low since the market made this low. So until the market pushes underneath this low or pushes over this high, hopefully you can see how we do not have a trend, right? What is a trend? Higher highs and higher lows. Right, so we have a low here and a high here. Market comes down. Once it broke past this high, we can say, hey, we have a higher high, so the trend is up. The market comes back down, makes this low, then comes up here, makes now another high. At this point, we can say we have an uptrend because we have higher highs, higher lows. When we cut off this part of the chart, though, and we only look at this, now the picture changes. Right? We have sideways. Short-term trend is up. We need to see this price move up in order for the market to make an uptrend. So again, as a strategic investor, we have to think about what would it take to put this market into an uptrend. It would be price breaking over this high. So price needs to go up in order to do that. And I apologize for maybe laboring over the point, but often that simple point is one that we neglect to remember. Okay. So at this stage of the game, what I'm doing is laying the foundation for my strategy, for my plan of what I want to do. So if I've marked down that the medium-term trend is up, but the short-term trend is sideways, we'll say. And like I said, there's some overlap there. We don't need to get bogged down on exactly 3 months or exactly 6 months. We just need a way of looking at the market. So we have two pictures here. One is a picture of an uptrend, one is a picture of sideways. Both of them are valid. Why? Because we've got to think about what will cause, or what we need to see if the trend is going to continue. We also need to focus on how will we know if the trend is not going to continue. Okay, so in here, price moves up, makes a new high, makes another new high. As price is coming down, if we are convinced that price has to go up, it's easier then to make really stupid mistakes. So again, what we're after here is context. So as the market now fails to make a higher low, in other words, it moves through this low, we can say, all right, well, it's not in an uptrend anymore, but it's also not in a downtrend until it breaks through this low, right? So price pops up again, comes back down. Now as we look back, we say, oh, hey, it's near this past low. This was the we'll call it the last major low. So if price breaks underneath this low, then I'm going to say downtrend. It didn't though, did it? Went sideways for a little while, went more sideways, and now it looks like it's been launched out of a cannon. At the same time that I say it's launched out of a cannon, I also have to acknowledge, well, there were other times that the market was moving up and it got stopped. So while I'll acknowledge there's still an uptrend in place, we've got some resistance up here in the form of sellers who, for some reason, when the market gets between 6,000 and 6,200, or 60 cents and 62 cents, that's where people have been selling. Okay, and again, this is all just the setup. And really, we've only been going at this for, I don't know, maybe 25 minutes or so. And so really, it does not take a lot of time once you understand the pieces that you have to put together. So what we've done so far is we have looked at the market from a strategic standpoint rather than just an opportunistic standpoint, where the opportunistic trader or the opportunity seeker comes in and says, okay, it's Tuesday, January 18th, how can I make some money today? The strategic investor says, okay, it's Tuesday, January 18th, and based on my strategy, this is what I'm going to look to do. So the strategic investor, let me sum it up, is looking for places on the chart where the market has made significant moves. And I know that you got to say, well, what does that mean? Well, a significant move is it's relative to the whole picture. Okay, you have to look at this entire thing. Now, to my eye, they're obvious, right? Well, those really are minor. So we have this. 1, 2, 3, 4, 5, 6. We have 6 significant highs and lows. 3 highs, 3 lows. That's it. All of these little wiggles in here, it's not that they're meaningless, they're just not significant. Now, as they say, a picture is worth 1,000 words. And this was one of the most challenging things that we meaning me and the programmer I hired in 2008 to do this. One of the hardest things for me to do is to talk about, well, how the heck do you find these? Okay, so if we're going to use a tool, meaning the computer, we have to be able to tell the computer how to find these. Unfortunately, computers don't get it when I say, well, just look at the picture and pick them out. And you may not either. So let me go over maybe a way for you to do this. First of all, you've got to zoom out. Okay, the closer that you're looking at something, meaning the less time, the harder this will be. So you want to zoom out, and you can see here we're going back to 2010. This is February. So we've got almost a year of 4-hour bars in the screen. And you want to flip-flop back and forth between where price is now and where it has been in the past. So if I look at this high, this would be the present, right? So I'm looking now. So if I'm looking at this high and I say, well, is this a significant high? I want to look back, and actually this might be a better high, but it's harder for you to see. So if I look backwards and don't see another high above it, I say, okay, that's a significant high. But then I want to move forward, and I want to look at this high. I say, okay, well, when I put these two together, or really, well, let's say these three, so we've got the market doing this, right? You can see this is kind of sideways. So it goes down, up, and then down. When I look at this, I look at this high and this low, I say, well, are these two significant? Well, then I have to hold these two in my mind and start going forward again. Then I look at where do I find another high or another low? And I say, okay, well, this high went over this one. So I'll mark this and this now as significant highs. Okay, so I'm holding all these in my mind again. The market moves down. And I say, well, what about this one? It didn't go, this was a really big move, I'm saying to myself. And so when the market moves down here, I have to say, well, is this significant? Then again, I have to hold this in my mind and then look over here. I need to move to the right again. I say, well, the market pushed above here and tried to go down and then pushed above here again. And so really, as the market started to move along, this high wasn't all that significant because price went past it. And it tried to go down a bunch of times and couldn't. So then that must mean this price was a significant low. So again, I'm kind of cycling through all the highs and lows. I'm comparing one to the other. I'm looking at how the market moved, meaning as the market was moving up, did it try to go down multiple times? Yeah, it did. So then why is this low significant? Or why does it have meaning? Why do we want to focus on it? Because, and we've got to go back to one of the foundational ideas here, which is market moves are not caused by retail traders. They're caused by, remember, the commercial traders, the strategic investors, the big money, the smart money. They're the ones who are going to step into the market and buy right there. Because remember, as price is moving down, the only thing that stops price from moving down is when buyers come in. So when the market moves down again, the only thing that's going to stop it from going down is what? More smart money buying. Now true, as the smart money buys and as people see the smart money buying, remember there's a kind of a ripple effect. You have the smart money buyers in the middle. You've got another ring, which are going to be people who know these guys in a trading relationship and who these guys share information with. Then you have another group which gets information from these guys. You have another group which gets information from these guys. Then you kind of have everybody else who don't get much information at all, but a little bit kind of filters out. A little bit. So we don't know for certain what these guys are doing. Okay, it's not like it's not like these two circles here where there's a direct sharing of information. We have to from an information standpoint, we can only guess. What we know is what's on the chart. So we have the low there, which we're trying to decide if it's significant. And it's significant because of what comes afterwards. And so what we get into is this dance, if you will, where we're looking at the past, we're moving a little bit forward, and then we're coming back again. And I realize I'm getting into a lot of detail here that maybe I haven't gotten into before, but it's because I'm trying to teach this in a different way. Because this is a breakdown of how a strategic investor looks at the market. And in fact, when I have modeled my trading mentors, this is exactly what they do. They get into this loop. So they're trying to decide, is this significant? They look forward, and then they look backwards. So they see a low on the chart. Well, is the market trying to go down repeatedly? Yes, it is. Then they'll look at how big these moves down are. Because when you get a big move in the market, that's a true test of the buyers. When the market's moving down, and it moves down a lot, don't we question our position? You know, if you're looking at your trading account and you see that it's down 5%, down 6%, down 7%, down 8%, you're thinking, whoa, did I make the right decision? Well, the smart money, if you pardon the pun, they're no dummies. So if this move was the smart money selling, well, they're not going to buy, right? They're going to sell. So the fact that the market went down a significant amount and went back up, it also helps to make this a significant price point. Again, because if the smart money bought down here and then the smart money was selling up here, well, you can bet that the market's going to continue moving down. For example, back here, the market stopped going down and moved up. It made a big move down here. The question is the smart money a buyer or a seller? Well, it continued going down, which means what? Well, the smart money wasn't buying. So we get to do the dance. We look forward, we compare moves, we look backwards. So it's a constant comparing of information. So once we see that there is a significant low, as price continues to print on the screen and time goes by, we judge, if you will, all of the price moves in the light of this one back here. So as price is coming down, we look to the left and we see, all right, well, this is at the top end of where the smart money bought. So if they're still buyers, guess what's going to happen? Price should move up. Price comes down. Now it drops through this low, doesn't it? And it comes back down to our significant low. What does it mean? Well, what it means is we have to ask and we have to look for the smart money to do something. If the smart money bought back here and they are still interested in buying, guess what they're going to do? They're going to buy again. If they're not interested in buying, this is what will happen. The market will continue to go down. Why? Because there aren't any buyers large enough to support the market and to convince the market makers, the banks, that price needs to go up. And then eventually price does go up. Okay, there's a whole lot of mucking around in here. Price is up, it's down, it's whipsawing back and forth. Sorry, I touched my laptop and it shocked me. That was weird. Sorry. So now that price has moved up, or let me say that a different way. As price is moving up, we assume, and it is just an assumption, that the smart money who bought back here is now buying or has bought over here. Now, if you ever want to understand why the market goes up and down, that's all you need to know. All you need to know is that it's likely that the smart money is buying. Well, then we have to say, well, if the smart money is buying, then the likely direction of the market is up. I mean, it's very simple logic. If there are dark clouds in the sky, it's likely that it will rain. If there are no clouds in the sky, it's not likely that it's going to rain. So I love to hear the weatherman. They say, well, there's a 20% chance of rain. When I hear that, what I hear is, well, there's an 80% chance that there's no rain. Now, maybe the prudent man will still take his umbrella, but I got to tell you, if I'm just playing the odds, I'm probably not going to worry about it raining. At the same time, though, I'm going to look up at the sky. You know, I don't need the weatherman for that, for crying out loud. So we need to look at what's going on. At the same time, look back, because we can see, okay, the smart money bought here. Well, obviously they stopped buying or actually started selling over here. Why do I say that? This is where the market started going down. And this is where the market started making with these minor lows, right? So minor lows are anything in between the major or significant low and high. Right, so we went through all those contortions, all the exercise, say significant low, significant high. Then that means all these little lows in here, all these little highs in here are just minor. It's not that they're unimportant, they're just not as important as the smart money highs and lows. So as price is moving up, we want to look backwards to see, are there any highs, are there any sellers in this area? And we can see, yeah, there are a few. So even though price has taken off like a rocket ship, the only thing that's going to keep it going are more buyers, folks. Nothing that we put on the chart is going to make price go up. You see, and I really think that for some people who have never had a chance to interact with the real market like I have and like other professional traders, it's hard to understand what really makes the market work. Just because you've never experienced it, you've never seen it. But for professional traders like me, where we've picked up the phone and we've talked to guys that are commanding huge, hundreds of millions of dollar positions, and we're talking to them on the phone, and we're talking about positions, we can see their orders going across in the marketplace. You understand on a very basic level what makes the market go. So the opportunity-minded investor is going to look at just this little piece, and they're going to say, okay, give me a tool that's going to make me some money today. Well, unless your tool takes into account all of what I just described, which, look, it's not stuff I made up. This is what I learned when I was trading at the hedge funds. It's what I learned at the syndicate rooms, and it's what I'm reinforcing now with the guys that mentor me now. The largest of which trade several $billion. This is how they look at the market. And since they are the ones that control the market, that make the big price moves, doesn't it make sense to do what they do? I mean, who do you want to follow? Very simple question. So we can hope, and this may not apply to anyone in the room or to you who asked the question, but we can hope that there's some tool that will give us an opportunity now. But hopefully what you can see is if it's not made with all of this stuff that I just went through, how does it have any prayer of succeeding? Especially over the long term. Well, I can tell you it doesn't. It just simply isn't logical. Okay, so finally, we've now constructed a strategy, and we're now ready to begin looking to do something. Now, this is very important. Up until this point, I have not thought about taking a trade. I'm not thinking about trading. I'm not thinking about opportunity because I didn't have a strategy. I didn't have a strategic point of view. I didn't have a plan. Otherwise, I would be falling into the category of the opportunity seeker that's simply sitting down and saying, hey, let's make some money right now. Now we've identified 1, 2, 3 areas where sellers have come in and the market has gone down, and we're actually very close to 2 of them. Now what I do is I put these areas together, especially when they're close, and I call them resistance zones. And here's the resistance zone. All I did was I connected that high and this high, and I made a box out of it. Now on Forex Deal Butler, there's a little box. Whoops. I click, hold the button down, drag it across, boom. Whoops. There we go. So now I've got my box. I have my resistance zone. Now you've got to write this information down. And so once I've written it down, what I'm looking for is when price enters into this box. Let me move it down just a skosh. There we go. Now I have a reason to look for short trades or to exit any positions I may have entered down here. Why do I have a reason? Because this is where the market reversed in the past. I have no idea if it's going to keep going in the future. I mean, come on. Nobody knows that. It's a joke that guys say that they do based on the last hour. There's no way that you could know that. Because what actually makes price move are people who are going to lie to you. I mean, they'll lie to their own mom. You know what I mean? That's just that's who they are. Because they know if they don't, they're not going to make as much money. Or they're, even worse, they're going to lose money. And oftentimes, and most of the time, it's not just their money. It's investors' money and everything else, everyone else. Okay, so we're in a resistance zone. I have an opportunity to take short trades here, but at the same time, I have to realize, hey, there's another high poking up over here. So even if price may not turn around and go down to 0 from here, it might push down a little bit and then pop back up, at which time I can then look to this price level. That has to go into my strategic plan. Otherwise, I'm open to making mistakes. All right, so what's the shortcut here, right? Because that's ultimately what we want, including me. This is where the dynamic RS came in. And what I just talked about over an hour Took quite a while to get into the computer reliably. So the dynamic RS lines are going to show me the price levels I need to be concerned with. So let me take this box. Whoops. Come on. My mouse is being difficult. There we go. All right, I just wanted to expand it a little bit. So the dynamic RS lines, you can see here, they're showing me short-term resistance levels, short-term support levels. When I take them off, see, it doesn't make a big difference. Yeah, I'll do it. I'll go to a daily. If well, actually, let me not. Okay, let's just continue there. So let me put these back on. Sorry for jumping around there. I was going to go in one direction because you can see these are what? These are minor support, minor resistance. And so it's on the chart so that I can have a record and have a shortcut. If I want the longer term or the major support and resistance, this is where I would need to go up to, for example, a daily chart. We're looking at a 4-hour, remember. So let's zoom in. So as the market has moved up, I'm looking back here, and I can see here's the minor resistance level up at 6,100. I've got my box. What I'm focused on now is finding a pattern. Okay, we're not done yet. We need to see more information in order to trade. Now let me say this, you could, or I guess let me say it a different way. Could you just sell it at the bottom of the resistance zone here and put your stop up here? Well, yeah, sure. It's not that that's bad. It's not that that's good. It's just different. Now, this is the point where most retail traders will say, well, how many times does this win? What's the winning percentage? Because the non-commercial trader, especially the opportunity seeker, is interested in how many times can I win, right? And so that's where the question gets asked. You know, what's your win rate? You know, is it 80%? Is it 70%? Is it 60%? Well, the commercial trader or the strategic trader realizes that these numbers are meaningless for the future, right? Let's say I had a system and I said, oh, well, this thing has won 80% in the past. Does that mean that the next 8 trades are going to be winners? No, not at all. In fact, the next 8 trades could be losers, and the system could still be 80% accurate. I'm not going to get into probabilities and all that. I've had guys with degrees in engineering, guys with degrees in physics who didn't understand how probabilities work. So at this point, it's not just about the probabilities or about the percentage win. Do we want to track the percentage win? Yes. Does the past percentage win give us any hope of making money in the future? No. But that's what most of the non-professional, the opportunity seeker in particular, wants to know. How much does it win? What's more important than that is, if I sell here and have my stop up here, how many times out of 100 do I need to win to be profitable? And if this number, right, if this big stop, if that means you've got to win 80% of the time, then I would say to you, you have a losing trading system over time. I can tell you, over time, I've never seen a system perform at 80%. Meaning, if you started it 10 years ago and you came up to today and looked at the whole thing, the win rate is, I've never seen anything up at 80%. I've seen systems where there are blocks of time, where it might be 80%, but never in the whole. So then what's the solution? Well, if there's no hope in percentages and probabilities don't work the way I think they do, then how the heck can I make any money? Well, this is where the 2-to-1 ratio comes in, because I know if I'm at 2-to-1, meaning if I'm entering here, I need to be able to see that there's a good reason for price to move 2 times what I'm risking. So if I've identified support, which I can see is down here, the RS lines are even showing it down here. If I can see the support is down here and that the market is way up here, well, I can see very quickly that this move is more than 2 times this, right? So you got this line compared to that line, it's more than 2-to-1. So I know that over time, even if I'm only 50% right, I'm not going to go broke. Here's the key. The key is making sure that what we risk and what we make doesn't require 80% winners. In fact, even better, I want to get down to where I only have to be right 30% of the time, which roughly speaking is 3-to-1. So if I'm trading at 3-to-1, I know, man, even if I'm right only 30%, I'm not going to go broke over time. Now again, opportunity seekers, the opportunistic investor doesn't like that. They're like, man, I want a guarantee. I want you to tell me that I'm going to win 80% of the time. And of course, the strategic professional investor says, hey, that just doesn't exist. So, what am I saying? What I'm saying is, once I get a pattern, no matter what that is, once I've decided there's a reason to trade, ahead of time, I need to understand how much money I'm going to risk and how I'm going to decide where I'm going to get out. So again, it's a cycle. I look to the possible position, and then I cycle back and say, okay, well, how much am I willing to risk? Before the pattern even shows up, I write it down, I put it on the piece of paper, and that's what I do. Because otherwise, it opens up the opportunity to make mistakes. So the rest of the tools on the Deal Butler are designed to use, well, let me actually say this a different way. All the tools, with the exception of the RS lines that you see here, are designed to be used as you are looking to get into a trade. So let's say we've decided, all right, we're going to sell as soon as price gets to this line. Well, at that moment is where I could look at the matrix. Now I can tell you that the matrix, after a price move like this, is going to show mostly buys, and that's fine. What I want to do is register that there's mostly buys, and then as time goes on, I want to see the lower time frames get mixed. Because what that means is the energy on the lower time frames is not pushing to the upside as strongly, and if it's not pushing as strongly, that means, well, hey, price is likely to be moving down. I want to see that over here, the pound generally stays weaker than the dollar. I apologize, I'm using a beta version of the software here. Whoops. I'm not sure why the map is not coming on. That's a bit frustrating. And just a slight bit embarrassing, actually. Sorry, I had to get something to drink. So then well, let me just make the point then. So this is where if I add on additional indicators, whether it's the map, whether it's the 3-bar reversal lines, no matter what I put on here, at that stage, it's designed to help me enter the market. As soon as I'm done entering the market, really, I should take them off. But if I do leave them on, I need to make sure that I have my trading plan written down. Otherwise, I can make a stupid decision. I can change my mind about a trade based on my emotion, based on my eating habits. You know, there are all sorts of things that can come into play at that point, and are a reality of trading. Okay, so I know we took up basically the whole hour with this first question, but as you can see, it strikes to the heart and the very core of what it is we're here to do, which is to make money in the market. And so let me sum up with this. You need to decide which group you want to be in. Do you want to keep the opportunity seeker mindset where, and so let me define that again, that's someone who wants to be able to sit down at their computer whenever they want and have a tool that says, here you can make some money. Or the strategic investor that develops a plan and has a strategy for trading in the marketplace. Now the odds, if you will, are 95% of the opportunity seeker, the opportunistic investors, fail. That's not to say that 100% of the strategic investors never fail. They do. They can. So nobody is bulletproof, if you will. So how does the opportunity seeker then make any money? Well, if your tool is based on at least the principles of the strategic investor, then you've got a shot. Because at least then the tool that's giving you the signal, having been built on how the market really works, how the people who make the market work are trading, you can hopefully understand that then you'll have some success. Otherwise, how can you? It's like you can, if you want, you could trust in the weatherman who says, there's a 20% chance of rain, which means there's an 80% chance that there won't be, and never look up at the sky, and that can work. More often than not, you're going to be carrying the umbrella and people are going to look at you like crazy because it's, you know, blaring sunny outside. Hey, Michael, you're welcome. Yeah, I'm glad I recorded that. All right, so that's one that should probably be shouted from the rooftops. But that basically is the Forex Steel Butler. That's what it was created for. That's what's behind it. That's why it took so long to develop. And it's also why it's not, you know, it's not some crazy robot. It is simply a tool that's built on how the smart money execute in the market, meaning how the smart money buy. And so let me take a moment to really dig into what that means. Most of the time, the smart money are sitting on their hands. They're not some crazy day trader smacking the keyboard trying to get in and out. Yes, there are strategic investors who trade that way, but they in general are not the guys. Let's zoom out here again. They are not the guys that turn the market here. They're just not. They don't have enough money. Their position size just simply can't be big enough. But the strategic investor, at some point when they want to buy, they've got to buy. Right? So they need someone to get in there and buy and sell and work price back and forth. So when you're putting on this gargantuan, huge, you know, universe-bending position, you can't just come in at one price and say, boom, get me in there. It doesn't work that way. And so the strategic investor will create a lot of this price action and a lot of this wiggling around. Actually, most of it was, let me back up. And I've gone over this in several other occasions. I'll just give you an overview of it here. The strategic investor will, you know, will typically start buying over here. They will cause this big move down because they want people puking on their shoes, if you will. And then every time the market dribbles to the downside, they'll buy. Well, and guess what? Pretty soon people realize, oh, holy crap, these big fish over here, these big buyers, the smart money, they're buying. So we need to buy. Boom! Price blows to the upside. That's a really quick synopsis of how the market actually works. Meaning when the strategic investor has to get in there in the moment and buy. Right? Let me give you hopefully another metaphor. When you're looking to buy, let's say a TV or a computer or, you know, a new stereo system, you could be going through all sorts of websites, all sorts of magazines, you know, reviews, consumer reports, all sorts of information. Well, that's your strategy for buying whatever it is you want to buy. But then at some point, you've got to actually go into the store or go onto the website and enter in your information, or hand the guy your credit card, or hand the guy your check or your cash, and you have to buy it. What I'm saying is when the smart money gets to that instant where they're looking to buy or they're looking to sell, it's more complex than you and I going out and buying a stereo. We go to buy a stereo or a TV, we just, boom, we buy it at one price. The market is different than that. And so this is where you get these types of formations like this, which, you know, like I said, we've talked about on and on. The Forex Steel Butler tool is designed with the strategies of the smart money, because I traded for them, Now, of course, it's not all of them, and I'm not saying that there aren't more out there. But the tools are designed with those trading styles in mind. And so we look at different time frames. See, that's why on the Christmas tree we've got 5-minute, 15-minute, 30-minute. The Forex Deal Butler is a tool to observe the market like a strategic investor. And so there are shortcuts, but there's still admittedly a lot of stuff going on here. Anyway, we've got a ton of stuff on the website. Well, I shouldn't say a ton of stuff. We have some very focused 10-minute topics where I go through each piece of the Forex Deal Butler so you can learn how to use it. Of course, with the daily videos, I'm focused on the Forex Deal Butler in particular. And we actually have two versions. One of the versions which you're seeing here does not trade automatically, but then we have another one which will help you to trade automatically. I'll just put it that way. All right, so I know we're over. I apologize. Let me get to the last two questions. Can you recommend a good broker? I actually am starting to talk about brokers since the government has stepped in and started regulating them. Trader's Choice FX. I know the principal over there, Alex Nekatrin, and then Compass FX. Again, I know the principals over there, Kim Pingleton in particular. Those are two introducing brokers where I know the owners. I have their cell phone numbers, talk to them regularly, and so I'm not saying that you won't have any problems when you go over there. But I am telling you that the owners of those firms can and will go to bat for you. So again, you've got Trader's Choice FX and then Compass FX as far as two introducing brokers where I know the principals. The last question is, are these turning points also called pivot lines? No, they're not. Pivot lines, depending on what type you mean, are totally different. And I don't want to get into a big discussion on them since I don't use them. I don't believe in them particularly. Can they work? Yes, but I think for different reasons than the guys who sell systems and sell daily pivot lines kind of stuff. All right, anyway, let's get done. I appreciate you coming out, everybody. We've got a lot of additions to the Hercules software. So if you don't have the latest copy, you're going to want to pick it up. Of course, the latest release version. You don't have I never subject you to the buggy beta versions that I have. So pick that up. If we didn't get to your questions or if you have additional ones, make sure you post them, and we'll get to them in the next session or in the meantime. God bless everyone.